Thank you all. It's a great pleasure to be back here in Dodge City again. I always enjoy it, and I was talking with your Convention and Visitors Bureau folks that my family and I like to do little day trips as well, so it's a wonderful community, a nice place to be. In the past, I've come and I've talked and presented our annual housing forecast that we do for all of the large markets across the state and Kansas as a whole. But this year we thought we'd change things up and do it a little bit differently and talk some about, speak with some local experts who actually can then give us a little more detail about what's happening on the ground. To set all of that up, I'll give just a brief outline of what we're seeing going on in housing markets, and then that can provide some context for our discussion. As you can see at your table, you should have a copy of the Ford County Housing Outlook publication. This is a publication that just summarizes information that's here in Ford County, and we're very, very grateful to Security First Title. They've been a longtime sponsor and supporter of the real estate program at Wichita State, and it's because of them that we're able to print this out and make it available. And then we're also very grateful for a partnership that we've had with the Kansas Association of Realtors and all of the local Realtor and MLS boards across the state, including the Dodge City Board of Realtors. It's been now about 12 years that we've been working with them, and we access all of the multiple listing services across the state. We make them talk to each other because every board uses a different vendor, and then that allows us to create statewide MLS statistics that we understand much better about what's going on in housing markets across the state of Kansas. And if it weren't for this partnership, we wouldn't be able to do that. So with that, let me kind of jump in. I hope you're enjoying the theme that we have here. When I met with my graphic designers this year, we said, they always meet with me and they ask kind of, what do you see? Let's come up with a theme, something to do. And I said, well, the housing markets across the state, they're just out of this world. And I go, I think we have our theme. And so they came up with all of these images, space from Hubble telescope and other explorers and so forth. And so we really enjoyed it. So what do I have here with this first slide? It's a picture of mortgage markets. And Jeremy presented the employment forecast and what's going on in labor markets. And that's one foundational element that we use to look at housing markets. But the other is mortgage financing, the cost and availability. And in this chart, you can see that the 30-year fixed mortgage rate, which is the blue line up there, has been bouncing around 3% here for a couple of years. And that's just, when we were running around 4%, I said these are stupid low rates and they just aren't sustainable. There's no way mortgage rates will go any lower. And as soon as an economist speaks definitively about anything, you should run for the hills. You know that they're going to be wrong. And so interest rates then proceeded to drop down, and we've been hovering around 3%. The line that I want to focus on, however, is the orange line, which is the Mortgage Bankers Association's forecast of the 30-year fixed mortgage rate that they're projecting through the end of next year. They just revised it after I put together these slides. It's now below a 4% rate by the end of 2022. And it's in the low, like 4.1, 4.2% by the end of 2023. And so very, very low mortgage rates. Even if we see this increase, we'd still be at historic lows. But nonetheless, that would be a significant increase from where we are right now. So we'll ask our panelists about what impact they think that might have on the market if the Mortgage Bankers Association is correct. This slide shows total home sales in the Dodge City area. It's actually the entire multiple listing service, so it's not just restricted to Ford County. And as you can see from this, the pink bars are actual home sales, whereas the blue line is the moving average to try and get through some of the seasonality that happens with home sales activity. And when we saw an increase that happened from 2018 to 2019, we've plateaued somewhat since then. And actually, year to date in 2021, home sales in the Dodge City area are down about 12% this year compared to where they were in 2020. One possible reason for that, and we'll ask our panelists for their perceptions, has been what's been happening with inventories. So this slide shows a number that we call months supply. And what we do is we take the number of homes that are available for sale in a given market, and we divide it by the average pace of sales over the past year. And so, for example, if there were 50 homes available for sale in the Dodge City area, and you were averaging 10 home sales per month, then you'd take 50 divided by 10, that would be a 5-month supply. Normally, we think of a balanced market as being between a 4 and 6 month supply. More than that, it tends to favor buyers. Less than that, we think it tends to be more of a seller's market. And as you can see from this chart, the blue line is the state of Kansas as a whole, and we've been in what we might call a seller's market since 2015. But that hasn't necessarily been the case in Dodge City. In the Dodge City area, typically you've ranged anywhere from, say, a 5 to 8 month supply. But over the last 2 years, you've really eaten through those inventories quickly. And now Dodge City is down on a level where you only have about a 2.5 month supply of homes available for sale. And that would be considered a very strong seller's market. Now, just because statistically we might say this is consistent with a seller's market, doesn't mean buyers and sellers are behaving that way. And so again, I'll ask our panelists to flesh that out a little bit more for us about what they're seeing and how that's impacting the local market. Finally here, I have sales prices. And if we do have a situation of strong demand, really good labor market, cheap mortgage rates, and we have limited inventories, you would expect to see home prices appreciating. And this is the median sale price of existing homes in the Dodge City area. The median sale price isn't a perfect measure of home price appreciation. If, for instance, you're in a situation where you have, say that you have low-end homes, moderately priced homes that are selling really, really quickly, you could see the median sale price decline even if every individual home is increasing in value. And so the median sale price, which is just the price at which half the homes sold for a higher price and half of them sold for a lower price, the composition of homes that are selling hot right now could impact that median sale price. And so, again, I'll ask our panelists what they see in terms of overall home price appreciation in the Dodge City area. I do have on the back of your publication, you'll see our statewide forecast of what we're forecasting for the state as a whole. And in the back of the room, you'll see copies of our large market forecasts, which you're welcome to take with you if you're interested in that. But with this little introduction, I'm going to go and talk to our panelists and see what they have to say. So let me begin by introducing them. First of all, we have Brian Delzeit. Brian is a real estate agent with Coldwell Banker Hancocks here in Dodge City. He's been a realtor since 2002, and his production has been just absolutely phenomenal. In fact, in 2017, it put him among the top 1% of agents in the entire Coldwell Banker system nationally. He's the only real estate agent outside the Kansas City area to accomplish that feat inside the state of Kansas. Brian is very active in the local community, and many of you know him as a 6-year city commissioner. So please join me in welcoming Brian. Joe DeMuth is Vice President of Mortgage Banking with Landmark National Bank in Dodge City, and he's also a fixture in the local community. Welcome, Joe, please. And finally, and certainly not least, we have Angelica Villanueva. Angelica is the president of the Dodge City Board of Realtors, and she's the broker owner of RE/MAX Viet here in Dodge City. She graduated from Dodge City High School and she went to K-State where she earned a degree in elementary education. So please join me in welcoming Angelica. Well, as I mentioned, home sales activity in the Dodge City area have slowed somewhat this year. Is this because demand has dropped off, or is it due to a lack of inventory that we mentioned? So I guess I have you here first before me, Brian, so why don't you go ahead and start out with that one. And please make sure you use your microphone so everyone can hear as well.
Okay. Stan, it is clearly inventory. There's no question about it. The buyer pool has not diminished by any means. As a matter of fact, Angelica and I can both bore you to death with thousands of stories that it is not uncommon, especially in this price range from roughly about 120,000 to about 220,000. We get anywhere from 7 to 14 offers per home within 36 hours. So the buyer pool is not diminished. The inventory has, and that is the reason why our incremental sales are down. Kind of give you an idea there. The sales we had in 19 ended up with 206. Year to date, we're 157. So overall sales from 19 are going to be down somewhere around 12-15%, and that's just due strictly to inventory. Is all that's causing that.
Angelica, what are you seeing the same thing, or?
Yeah, I agree completely with Brian. We have a lot of buyers right now. Some buyers are kind of even stopped bidding just because they're tired of, hey, sorry you didn't get it this time, but we don't have enough inventory even with the builders. They're not building fast enough, and sellers are, we just have a lot of buyers and not enough inventory.
Well, Joe, I'm going to take the next question and start with you on this. As we saw, the inventory of homes available for sale has fallen dramatically, and Brian and Angelica have said, no, it's shortage of inventory. So how does that impact buyers and what they need to do to be well prepared? And in particular, one of the reasons I'm asking you is sometimes you see those prospective buyers before they go and speak with a realtor. And so how are you advising them to prepare themselves well to enter the market and buy if they're interested in buying?
Sure. Well, the realtors always do recommend they come see us before they go see them, just so they can get pre-approved. But like Brian mentioned, with multiple offers coming in on each property, I may have 10 pre-approvals, 10 people that are vying for that same property, and the realtors are kind of advising a lot of the buyers or the sellers, to not consider government financing. And most of our buyers, or a good percentage of them, I would say probably half our buyers in Dodge City, are looking for rural development or FHA financing. They're government programs that have minimum down payment, and that's always kind of been the problem in Dodge, is until they started getting the raises at the packing plants anyway, they just don't have the funds to put down. So if they do the government programs, it's minimal investment, but there's also additional repair requirements. Conventional is obviously easier. So a lot of my buyers are being excluded from being considered as a buyer because they're pre-approved for a government loan.
Okay, and just to clarify, sometimes we hear about pre-qualification versus pre-approval. And can you kind of clarify the distinction between those and why pre-approval is especially important right now? What do I go through to get pre-approved as opposed to just pre-qualified?
If you ask my boss, we don't do pre-approvals, it's just pre-qualifications. But typically we're going to look at their income, we're going to look at their assets, we're going to look at their credit, basically everything but an appraisal.
And you'll actually verify those things as opposed to just take their word for it if they say that's how much they make.
Absolutely, yes. Yeah.
Okay.
We have pay stubs, W-2s, that type of thing.
Very good. Well, Angelica, what are you telling your buyers in terms of how to get ready and what to be prepared for given the tight market and the...
I think it's kind of what Joe said, just, the first-time home buyers and the benefits here in town. We can have an RD loan, which is rural development loan, and a lot of them that have that pre-approval can't get them can't use that loan because if you have 14 offers on a house and you have a seller's agent, he's going to tell you, hey, it's better to go with a conventional loan than a RD loan, and so they're automatically, discarded. So now
And it's worth asking the question, why would a seller care what type of financing the buyer might have? I mean, as long as they can get qualified for the loan, what do I care what the type is?
So for example, a conventional loan versus an RD loan, RD loan has a little bit more things that the house requires. So GFIs in the kitchens and bathrooms. They can't have any chip paint. If there's a handle or any stairs, certain length, they have to have a railing. And so with a conventional loan, it's a lot easier. They don't have those requirements. And so sometimes it might just be $200, $300, but sometimes it could be a lot. So for a seller, they're looking at it as there's going to be less things that they have to pay. Also, a conventional loan, you're putting anywhere from 5% down to RD loan that you're putting nothing down, and so you think, okay, it's a stronger buyer. So the likelihood of being able to close is going to be higher than it is on an RD loan. And an RD loan usually takes about 45 days, and a conventional most likely will be 30. And I think another thing too, an appraisal. We don't have as many appraisers here, and so some aren't licensed to do an RD or an FHA appraisal as a conventional loan. All of them are. So time-wise and getting that appraisal in takes a little bit longer as well.
Right. And speaking to some of those inspection issues that you mentioned with the RD loan or with an FHA loan, typically it is going to be the seller that is required to take care of that, as opposed to something that they can negotiate, and the buyer could just say, okay, I know that I need to swap out some outlets, I know that I need to put in this handrail, and then they could waive that as far as a condition for selling it. That's not an option when you move to those other loans.
And usually on an RD loan, they don't have the money, even if they wanted to be able to do that. So usually a conventional loan, since you're not going to require it, most buyers on an RD loan have just the bare minimum what they need, and so you add the extra cost.
Yeah, very good. Well, Brian, how are you advising buyers, and at the same time, how are you advising sellers when it comes to dealing with this market?
Quite frankly, Angelica was amazing. She pretty much hit every detail. It really comes down to dollars and cents and times. What I tell a seller is this: we forever have never had an issue with an FHA versus RD versus conventional. They're all outstanding loans, and if the bank says they're pre-qualified, they're pre-qualified. It's good. It's most likely going to happen. But it comes down to time and money. The money she hit on, there's a few additional repairs that a seller's got to make on any type of loan other than conventional. So if you're going to get more than a handful of offers, why would you take a loan that's going to cost you more, that's going to cost you even $200 or $300 more to sell your house? Why would you do that? The other reason is, I point out to my sellers, especially from about April till October, that is our storm season. Angelica indicated that all the other types of loans other than conventional take 6 weeks to close, conventional takes 4. That 2 weeks, in my experience, sometimes can cost the seller that deductible on their insurance. The storm comes through. So time is important. We can close 2 weeks faster. And there's other things that happen. People quit their jobs. People get buyer's remorse. And so the sooner we can wrap this up, the better it is. We are seeing a lot of buyer's remorse this year. We've got 4 that happened between last week and this week. And it's a scenario where buyers are simply bidding atrocious numbers. And I think a couple of nights later, after they realize what they did, they go, oh my gosh, I want out. And it's happening. So the sooner we can get that buyer closed, the better off it is. What am I telling buyers? Exactly what Joe said. You want to be competitive, the best way to be competitive is to go in with a conventional loan. Again, RD loans and FHA loans are outstanding loans. We've used them forever. But from a competitive standpoint, you've got to let that buyer know that you're probably going to be one of 10 people. So you want to go in with a conventional loan because you're not going to cause that seller any additional repairs for your type of loan, and you're going to close 2 weeks faster.
When we were in Hayes yesterday, one of the panelists mentioned that they're beginning to see many more instances of bridge loans from buyers, so that they will go to their lender, they'll get a loan that will cover their existing house and the new house, so that they can come in and not have to be contingent on the sale of their existing house to have the cash. Are you seeing that sort of thing as well?
Yeah, we're telling people, don't even think about making us a contingency offer. By that, what we mean is a contingency of sale. Meaning you need to sell your existing home in order to buy the new home. And we just tell them, you're not even gonna be considered. Because there's no matter what you offer in dollars and cents, you cannot guarantee a closing date, because we don't know when your house is gonna sell. So in today's market, that's almost unheard of. So the bridge loans that Stan's referencing is their only option to do. And Joe could go into more detail on that. Not everybody qualifies for a bridge loan. You gotta have a certain percentage of equity in the home to even pursue that.
And there's another thing that I've seen that I hadn't seen before is parents are refinancing their house to pay a house cash, and then their son or daughter buys it from them. But that way they have a better chance of getting it, because cash obviously is king. So a lot of parents we've seen doing that. If they own their home, they'll refinance it and be able to buy the kid cash, and then their child will pay them back, get a loan and then do it that way.
Very good. I'll just tell you, when I was in Lawrence a couple weeks ago, I don't think I've seen this in Kansas yet, but one of them mentioned that they've been at a conference and they're starting to see in some parts of the country hard money lenders. So you would get a loan from somebody that would be a 90-day loan or a 120-day loan to get the cash. So you could be a cash offer buyer. And then once you have that, then you go and you get your financing in place to put it in. You pay off the hard money lender for the piece. So we haven't seen that yet, but there are creative ways that buyers will address to try and take advantage of to be competitive in the market.
And Stan, there's one other thing that we've learned with this competition is that buyers are making some pretty crazy bets, going $20,000, $30,000 over list, sometimes higher. The listing agent knows that the home is not going to appraise for that dollar amount. So why even pursue that buyer? That's what when I'm the listing agent, that's what I tell my seller. Don't be engulfed in that. Don't think it's Merry Christmas to you, because the appraiser, first of all, has to approve that. It's not going to happen. So what I tell buyers, when I have the buyer, however, I tell them that this is going to happen. Somebody's going to do this. And they're looking for a seller whose agent is not going to educate them properly, and they're going to take that, and then of course it's going to appraise for less, and they'll get the house bought for less. So I said, let's do this. If you want to go in $15,000 over, let's guarantee it. And how we do that is, regardless, we put a guarantee in the purchase contract that regardless what that home appraises for, if it's a $200,000 house and we're offering $230,000, regardless what it pays for, we guarantee them we will close. And how we do that is we demonstrate that we have the cash above and beyond the expected down payment and loan fees to make up that difference between $200,000 and $230,000. And we prove to the seller we have that cash. And we'll put it in escrow if necessary to show them how strong we are.
Yeah, 'cause
So-
from a bank's perspective, we're limited to the lesser of purchase price or appraised value. So like you said, if sales price is 200 and it appraises at 175, we're keying off that 175 figure. So that difference of 25 they got to pay out of pocket.
So that raises the question, are you seeing appraisals that are not coming in at the proposed purchase price? And then what are buyers and sellers doing? Or are appraisals mostly doing okay?
Everything that I've seen, they're doing okay. There's some I'm like, that's not going to appraise, and it appraises. It just, we have asked the appraisers, because obviously we don't want it to get to a point where it's too high, but they just said because of one of the things that they're doing is, even if they don't have comparables, is since there's a lack of inventory, they're able to put more of a percentage on the house because of the lack of inventory. So But
Very good.
at least at our office, we've seen that it's appraising.
Joe, you see a lot because you
I-
deal with the lending
I
side.
look at a lot of appraisals and I shake my head. A lot of them that come in, it's like, you gotta be kidding me. But I'm looking at homes that, I just had one here a couple weeks ago that sold 3 years ago. I think they paid $230 for this house, and then they just sold it for $290. And I mean, they haven't done a thing to it. That's just 3 years market time. But you know, as long as there's comparable sales, and that's the key when they do an appraisal, is they have to find other homes of a comparable neighborhood, comparable size, other amenities that have sold within the last 6 months, and that's how they justify that value. But with home sales in Dodge City, what they've been doing, it's really not that difficult to find a comparable sale that will justify that price at the present time.
So it sounds then like you think that the increase in median sale price that we've been seeing is reflecting true appreciation of local home values. Is that a fair statement? How fast are home prices appreciating in Dodge City?
I'm gonna take.
That's a good word.
This appraisal scenario is absurd. It appears to me that the industry has forgotten 2008. What happened to our economy in 2008 due to the real estate industry, due to very unprofessional appraisals. Stan, to answer your question, yes, we now have comps demonstrating absurd prices. But the question is how did those comps get there? They never should have occurred. The example Joe gave is absurd, that any appraiser appraised that. We have one that we sold in the first quarter of 2000 for $139,000. We sold it at the top of its market. And the folks did nothing to it, and it just sold for $207,000. There's not a comparison in Dodge City, Kansas that proves that house worthy of $207, but it appraised. Somebody made it appraised. So here's what happened, Stan. It never should have happened. But now that it happened, that's a comparison.
Could there have been cases of cash buyers? So, you know, or you gave the example of making a guarantee. If it comes low on the appraisal, then I'll go ahead and guarantee that difference, because that low appraisal for that one, if I then guaranteed and I said, I'm gonna pay $225 for it, even though the appraisal only came in at $175, that now becomes a data point for an appraiser for the next appraisal.
Yeah, there's very few of those that actually wound up occurring. The
appraisals are coming through despite the guarantee.
Yeah, because like if it's a cash, usually it's not over. You know, if it is, it's not very much. And just because it is a cash offer, they'll accept it that way.
Say, from my experience, appraisals really aren't worth the paper they're written on. I mean, we have to have them to get the loan, but I mean, I can think of a scenario at the bank that we had 2 appraisals on a property in excess of $500,000, and we barely got 200 out of the property. I mean, it's just the appraisals is an opinion. It should be an educated opinion, just like a blue book when you're buying a vehicle. You got a book that says this is what the value should be, and it's an educated opinion as far as the value, but it's not absolute.
So, well, one way that we can address the shortage of inventory is to build new homes. And so, question that I have for you is, what kind of new home construction projects, how is that working in the Dodge City area? And do you see that as something that will help resolve the inventory issues in either the short term or the medium term?
Yeah, I can. So we do have a few builders building homes. Obviously, it's not fast enough, but they're 2 different type of builders in the fact that one can hold the whole loan or the whole process. They don't. The buyer can actually just put down the earnest money. The builder puts all the money up until closing. So those are, you know, our RD loan, our FHA buyers are able to get those more affordably because they don't have to get a construction loan, which usually a construction loan is that 20% down. And I know we have a new builder that's having a few, I think 100 and something new houses, but I believe they have to have a construction loan, so it's more of a down payment, plus they have to buy the lot. So those buyers, you aren't gonna have as many that have that kind of cash flow to be able to do that.
Yeah, so when you're a buyer and you're buying a new home, you have to have first a construction loan to get you through the process of building that, and then you get permanent financing in place. And you're saying the first type of home builder would actually cover the construction costs for them, presumably reap that back partially through a higher sale price. But that makes it open to a wider group of potential buyers.
Correct, and the only thing that there is, for example, he has 20 that have, I think less than that right now, but that windows haven't came in. So, here we're thinking maybe he'd be done with construction by November. Well, now he's like, I don't know, those windows should have been here since July. So all of those things are, making it even harder to get done.
Supply chain issues affect us in a lot of different ways. So you talked about the appraisals and feeling like they just seem to be extraordinarily high. How does the cost, if I wanted to buy a home that was an existing home versus build a home, how is that cost difference balancing out? Does that make sense? So in Wichita for a lot of years, we had new home construction. As we whittled down those inventories, new home construction didn't really pick up. And part of that was because the value proposition. The cost of construction had gone up so high and existing home prices hadn't increased. And so it really became hard to justify paying the premium to get a new home versus an existing home. And now that appreciation is starting to balance that out a bit more, and we're seeing more new home construction. Is there a real difference there between buying a new home versus an existing home, or is that relatively balanced here?
It has, Stan, it is definitely balanced out. And the reason why is because of our rapid appreciation in the last 18 months. So, great example, the area that Tim built north of Cox Communication up there, we had those under contract before he had them framed. The new area of Candle Tree that Tim has got developed, there was over half of that under contract, sort of, kinda. We couldn't guarantee the price because we didn't know what the prices were going to be, but yet people had earnest money down on them. And so if you go up there, you won't even find a lot for sale right now.
Yep.
There's another new area
Millstock.
off of Millstock Avenue that just was sold in the last, 6 months and platted, and it's pretty much sold out yet. And
He has 3 lots available,
yeah.
and there's not even a street in yet.
There's
or
not even a
entrance.
street, so it has definitely balanced out. And even the upper end market, Summerlawn has seen more sales in the last 2 or 3 years than what we've seen in the history of that. So it's clearly balancing itself.
Dodge
Tim.
City's a hot place to be, evidently.
Yeah.
When Volts was built north of Cox, his cost up there was sales was about $150 a square foot. That's always kind of been the difference to me, an existing and a new home. An existing home used to be $90 to $100 a square foot compared to $150 for new construction. But that's where I would have to say it's balanced out as well, because existing homes are selling right now for anywhere from 110. I've seen it's probably as high as $160 a square foot for an existing home, which is basically the same cost as new construction.
Very good. Well, most of us don't go and enter the housing market every year and buy or sell our house. And so some of us who are existing homeowners may get a little bit of sticker shock a little bit later when their property tax bill comes in. And so obviously the property tax bill is a combination of your assessed value, which has been going up, and the mill rate. So how will that all fit together in terms of what happens with property taxes and what you expect from that?
Property taxes are obviously going to increase, based on the value. But Stan, to put it in a total perspective, in 19 our average price was $147,000. Right now it's roughly, if I could round that to 150, right now it's roughly 180. It's a $30,000 price increase. So $30,000 over 30 years at 3%, about $125 a month. The increase in property taxes on that 30,000 is another almost 600, so that's $50
per year.
So a year, increase. So you're talking from 2019 to 2021, that average price home in Dodge City, the payback on it just increased $150 to $175 a month. So that's the profound effect that it's had. And it's
Well, now I'm going to put you on the spot a little bit here in your city commissioner role, because obviously one way you could deal with that is lower the mill levy. Now, you can't do it for the school district and for the others, but
I'm just going to make this statement on behalf of all the taxing entities. Thou shalt lower their mill levies when these interest rate, when the taxes go up. Property taxes are going to go up, and I think we have four of the most responsible taxing entities in the state of Kansas, and I truly believe, I won't be here because my term is up in December and I'm not running again, but there's not a doubt in my mind, Stan, that obviously the property tax are going to increase, and I don't believe any of the taxing entities are going to look at it as Merry Christmas to us, nice increase in revenue. I believe they will lower their mill levy to let that balance out. And I'm just going to let them all sit out there and decide their own.
or maybe find some in between.
Yeah,
where
something
they
in
lower
between.
it to take care of that.
Yeah, the taxing entities in Dodge have always been very good about that, and I think you'll see that continue.
Very good.
Not a doubt in my mind. So.
Well, I mentioned before that Mortgage Bankers Association is forecasting the 30-year fixed mortgage rate to go up to 4%, just under 4% by the end of next year. And while 4% is still an incredibly low rate historically, going from 3% to 4% is a 33% increase. So maybe people will perceive that as a big jump. How do you think that'll affect the local housing market? And we'll start with you, Joe, since you're the one who gets to deal with it first.
Right. Well, I think it'll definitely have an impact. Like I said, most of my buyers are pre-approved for government financing, the rural development and FHA, and they're very strict on debt ratio. They look at their income versus their debt, and a lot of these buyers are taking it to the maximum, maximum ratios. And a 1% increase on a $100,000 loan is about a $60 increase per year. So that's probably going to have an impact of about a $10,000 difference in purchase price. That they're going to be a lower approval amount because of that interest rate going up. So it'll definitely have a little bit of an impact.
Angelica, do you think that if they've got $10,000 less in purchasing power, does that mean that they drop out of the market entirely, or do they just change what the house is that they're looking for?
I think some of them do drop out just because, obviously the more expensive houses, the nicer they get. So once they've already been looking at a certain price and the type of house they're getting, and that $10,000 makes a big difference sometimes. And so I do think it might be, a changer for the buyer if they're going to decide to do it.
Very good. Brian, did you have anything you wanted to add there?
Angelica nailed it. She's 100% accurate. The only thing that may change their thought process would be the fluctuation in rental prices. If rental prices do sharply increase, which we think will happen with the growth of Dodge City, that may influence their thought process and put them right back into the buying market.
Yeah.
You always have to think about markets as the alternative that you have.
Correct.
Rental is an alternative to owning. Well, we have just a couple minutes left. If there are any questions that we didn't address, does anybody have a question you wanted to ask of our panelists? Well, I'm not seeing anything, and so we'll certainly be. Oh, I think I saw one little hand here. Go ahead.
No, I'll do it. Dodge City is very diverse, and we have a very large immigrant presence in the community. Are you seeing more banks lending or lending agencies approve loans for those who only have employment authorization?
I'm sorry, you only have what?
So the question.
Only have employment authorization?
Yeah. So the question is, if they just have green card, for
It's
instance.
actually lesser than a green.
Oh, lesser than
Right.
green card. Just has employment authorization. Are they going to get approved for a loan?
They can. It's much more difficult, and it does depend on how they entered here, if they're here illegally, how long they've had that employment authorization, if it's been renewed previously. But typically, they do not qualify for government programs, so they'd have to look at conventional financing is about the only type of loan we can offer if they just have employment authorization.
We do have a few banks that we work with that do allow, even with an ITIN number. Obviously, they're always on an adjustable interest rate, and they always require anywhere from 20 to 30% down. And so we do have banks that are local banks that are working with those individuals that are in that status. And I know with the type of the visas, there's different ones. There's some that are just once a year, twice a year, once every 2 years. It fluctuates a little bit, but we do have banks that, you know, if they can show that, hey, it's been 3 years and they've renewed it, we have banks that work with them too. So I think once we have a buyer that has been able to purchase, the word kind of gets around, and so they start knowing where, you know, where to go and what to do to be able to purchase that way.
Very good. Well, we've got a couple more questions, but I want to make sure we stay on time here. So I thank you all very much, and we'll be around and happy to answer questions later. So please join me in thanking our panelists. So.